Okay, well, let's welcome in our first guest on the program. Ed Yardeni is president at Yardeni Research. He's joining us right now to take some questions and run us through what he's making of things. Ed, great to have you with us here on the program. Appreciate your time here on CNBC TV 18. Let me begin by sort of putting to you and asking you rather two things. One, we got a very strong rally in the US. The Nasdaq was up about 2%. And I was saying earlier that it didn't look like it had too many fundamental underpinnings. It looked a mix of technical, seasonality, et cetera, et cetera. Would you agree with it? That's one. And second is, midweek, we get this meeting between President Biden and Xi. How important is it going to be? Go on.
Well, I mean, starting with the meeting, I think it's extremely important. And I think the fact that their meeting indicates that we're still able to talk to one another, hopefully bring some of the tensions that are occurring in Asia downwards and also deal with some of the other geopolitical issues. So any lines of communication is a good thing. And I think the market will welcome that kind of conversation. With regards to the rally we've had, it's been really intense. It's the S&P 500 is up over 7% since late October. And I think the reason for that is investors have come around to believe, and I agree, that the Fed is done, that inflation is likely to continue to moderate, that the economy, which was very strong in the fourth quarter, is likely to cool down somewhat, but not go into a recession. And I think we found buyers for the bonds somewhere between 4.5% and 5%. I think as long as the bond yield stabilizes below 5%, and as long as oil prices don't keep taking a dive here, because that's an indication of what's going on in the global economy, I think the stock market can move higher. I'm still expecting 4,600 on the S&P 500 by year end, and I think next year we'll go even higher.
Right. Hi, Ed. Good morning, and thanks so much for joining in here. If the global markets are going to do well, what about an emerging market like India? We have obviously a couple of domestic factors like state elections that will play out. But in a good global market environment and with the bond yields as well as crude prices being well behaved, what are the chances we move higher and outperform from here?
Let's start with the global bad news. The bad news is China's economy is going to continue to be challenged by the bursting of their property bubble. Europe has some challenges. Europe is in a recession, a mild recession, in my opinion. The U.S. Growth rate is going to slow, but we're not going to go into recession. But the good news for emerging markets, particularly India, is that global interest rates may have less upward pressure now that the Fed is done, in my opinion. And indeed, the other big issue, of course, is oil prices. It was only a few weeks ago that everybody was fretting that the price of oil could go up to like $100 a barrel. And I think the markets has demonstrated that just the global economy isn't strong enough to handle that. And we may very well be in an environment where the price of oil is around $75, $85 a barrel. And so I think both of those developments are good for India and other emerging markets, as well as the dollar probably isn't going to continue to strengthen, but I don't think it's going to weaken a lot. But so there's three happy developments, I think, for emerging markets, broadly speaking, but specifically for India.
All right, we've been hearing so much happy Diwali, happy developments sound better when they rhyme with happy Diwali as well. Ed, just wanted your thoughts on two things in particular. One, you said that the global market believes that the US is done raising rates. So the question now is, when do they take the first rate cut? How long is it going to be a pause mode before that first cut is happened? And secondly, what do you make of the geopolitical situation? Things haven't gotten better from the time we last spoke, but global commodity prices suggest that maybe it's localized and limited, so they're probably not as big a risk as they were earlier thought to be. Your thoughts on both these two things?
Well, I think with regards to the perceptions of interest rates and when they're going to go down, I'm in no rush to see interest rates decline. I think one of the things we're learning here is that the U.S. economy is able to handle 4.5% to 5% bonds. But that was where bond yields were before the great financial crisis. And for several years, we had 4.5% to 5%. In the 2003, 4, 5, 6, 7, we had that kind of range, and the economy did fine, and the stock market did fine. So in some ways, we're back to the old normal. The abnormal was what we had between the great financial crisis and the great virus crisis. So I don't need the interest rates to go down for the stock market to go up. I think just having them stabilize is an important thing. The geopolitical issues are very disturbing, very unsettling. But so far, the war between Hamas and Israel seems to be staying localized. There's still some skirmishing up in the north with Hezbollah, and of course, there's still issues for the U.S. with Iranian surrogates attacking U.S. forces in Iraq and Syria. But so far, it looks as though nobody really wants to see this thing just blow out of proportion, and wants to keep it as localized as possible on all sides. And so that's a good development. Unfortunately, the world's kind of gotten used to the confrontation between Russia and the Ukraine, and so I don't know that has any macro significance. But you're right. You look at the commodity prices, and if that's all the news you got, it would be hard to imagine that there's this kind of geopolitical turmoil going on, given the weakness in commodity prices and the calm.
All right, Ed, we'll leave it there.
Thank you.
I mean, the geopolitics of it is interesting, isn't it? But the hot wars that you described, Russia, Ukraine, Hamas, and Israel, and then there is the Cold War, which is, in a way, the new Cold War, China and US. And what happens with regards to that, middle of the week when the two presidents meet, I think that will be equally significant as well. Thanks very much, Ed. Great to have you with us, as always. We'll take